Alrighty, check, radio check. I want to welcome everybody to the Thursday afternoon chat with Chris. First of all, thank you for taking time out of your day to spend time with me and us. And for those of you that have not been on this call before, really the format is let me show you what's possible in different areas. And then if something you have a question, you want to find more, certainly we can help in that area. This is an area, long-term care it's a scary topic, right? Because I was speaking to a person last week, and when I started to probe a little bit, people tend to want long-term care when they know somebody that has needed it, experienced it, watched it wipe out family wealth, transitional wealth. And the problem in the industry is that the product, when it's first formed, almost 30 years ago, we didn't know what medical costs were going to be. So a lot of insurance companies entered into a actuarial area blind. They had no idea how to price the products. So by default, one of the things I learned early in my career is that the rates of a traditional long-term care product are not guaranteed. So I've seen that happen time and time again. It's happened to my mother. And as I've seen and understood the product, I've seen the industry go through phases. I've seen large insurance companies create products, start to become leaders in the long-term care industry, only to stop offering it. Case in point, I do federal employee benefits, and John Hancock was the only company to offer long-term care benefits to federal employees, and they have left the marketplace. Genworth, I mean, billion-dollar company, I think it was 2016, took record losses in excess of $6 billion. So if insurance companies, we all know by default, insurance companies are not going to put themselves in a position where they're going to lose money. So what happened is they left the marketplace. But some products have come up in what I refer to as hybrids, right? Where they're able to take products that are, annuities or life insurance and access those death benefits or cash values in a tax-favored way. And then if used for long-term care, can actually be received tax-free. So, that's where the point is here today. There's a product that, I think in today's world, there's not a lot of long-term care options. Most of them are hybrids. I think only one or two true long-term carriers still exist. And if I run a quote on that, the first words out of somebody's mouth, if they're 60, 65, too expensive, right? It's just too expensive. It's like throwing money out the window, and then the rates aren't guaranteed, right? So it really is a problem. So what I wanted to show you here in New Jersey is the cost of long-term care in New Jersey. And this is, just alarming because, first of all, when we think of long-term care, we think, who do we know in our life that needed it, right? Maybe it was a parent, maybe it was a grandparent, maybe it was an aunt or uncle, or maybe one of our spouse's family. But, as the more and more I've started to see this happen real time, nursing home, private room, New Jersey, median is $142,000 a year. Now, the problem with long-term care is we don't know what the ailment is. And when we see this word, here's what I know for a fact that I've learned along the way: nursing home, even assisted living. People don't want to go to nursing homes to have care. And the reason is because inwardly, we feel like that's where you go to die. And it really is a depressing thought. If you're going to have care, what people want to gravitate towards is this home health care. So in New Jersey, you know what? If you could have somebody come in and take care of you, that's at least somewhat reasonable, 60 grand. And that's in today's dollars. We have to understand that the costs are going up 3 to 4% a year. Inflation is here. We hear it all over TV. Medical advancement, things are going to get more and more expensive. And the question is, how do we pay for it? So what I wanted to do is show you a product, a design that sometimes could be a fit for some people. I hope none of you ever need it. And that's the challenge with insurance, right? Nobody likes paying for insurance. We like insurance, we like coverage. Thank God we have it should something happen, but it's paying the premium. So what do? This year is items to consider before using an IRA or 401k. You go, well, can you do that? And the answer is yes. This company is the only company that I know of that allows us to use qualified money. Qualified means tax deferred money, money that you put into an IRA or 401k, 403b, TSP, all those tax codes. So the first thing we want to be cognizant of is the age of distribution. It's ideal if after age 59 and a half. And the reason is because we can avoid that 10% penalty that we're all familiar with. If you do decide to do a plan like this, a strategy, moving it to the actual the vehicle and the strategy is not tax-free yet. It's a transfer from an IRA to an IRA, and then the annuity that it's put into will pay it out over 10 years to fund the policy. This is a key question because I deal with people of all, economic backgrounds. I deal with, the affluent, and I deal with people that, they hope they can make it. If you have only, $50,000 or $100,000 in your IRA, this is probably not a solution for you. But where I start to find it's interesting, where, as I've been looking closer and closer, especially in the New Jersey area, I've seen people have just been banking and then making record gains in the market over the last 10 years. Their 401ks have ballooned. Their TSPs have ballooned. Well, what if we could carve out a portion of that, $100,000, $200,000, $300,000 of money that we probably won't need for retirement, and earmark that for long-term care? Would that help? And the answer is absolutely. And here's the other thing. If you're on this call and you're married, this is a strategy where one IRA or one person's qualified funds can actually be used to purchase the long-term care strategy, and it will insure 2 lives. So it really is cool. You'll see that here in a second. Long-term care claims and death claims are income tax free. So if you do go out on claim and you actually need to start to receive the benefit, it's not reported on your taxes. And then, hey, one thing is certain in life, and that's death and taxes. If that does happen, the proceeds will be income tax free. So keep that in mind. And then lastly, consider an inflation rider. That's the one area where, just because today I was looking at that number, 149,000 for New Jersey. And just, I lost one of my good clients in 2015, and 2 years later, his wife, and they were living down here at Briarwood and Lakewood. She had gone into an assisted living, and it was $100,000 a year. So to see it at 150 doesn't shock me, but it is a pretty quick acceleration. And I'm going to bring up a website. Any of you can go play with this if you want to. It's a tool that you can use real time and test and just work around with it yourselves. And then if you want to, explore it further, we can go from there. But it's www.oneamerica.com. And then it looks like it's / care solutions calculator / index.html. And it's just going to show you, like I said, just another way to do it. So the reason I'm going to show you this, I have a client that I've met that he's single. He's 64 years old. He's retiring at the end of this year. As we were talking through, this was an area that he absolutely said, you know what? I don't have anybody to take care of me should I get older, and I don't want to go to a nursing home. So I'm going to present this solution to him next week when I speak to him. But for now, I just said, let's put in. So you put in your details, your state. The product is called Asset Care. You can see here, it's single life or joint. I'm going to show 2 examples, but the single life, you put that in. I put me as a prospect for anonymity reasons, obviously. I am not 64. Non-smoker. And then you want to select the single premium annuity. So what's happening is the funds are going to go into And let me do it, I'll use 150 and $150,000 is in his 401k at work. So he doesn't need that money. We've already done an analysis, so it's fine. So when he retires, it's going to be one of the areas where I suggest to him, look, we could put that with this company and they're going to give a 20% bonus. And that bonus is going to take the 150 immediately to 180. So 180,000. And then if we scroll down, you have to make sure you check off qualified. And we want the longest benefits as we can. 50 months is the actual core, and we'll go into that. Now, the continuation of benefits, 10 pay, I wanted this, and this is a key point. This is the only company I know that offers lifetime. A lot of carriers out there will call it long-term care, but when they're showing you products, they're saying, well, the average nursing home care stay is 3 years or 5 years. Well, suppose you live beyond the average. Well, then, if it's 150 today, what's it going to be 20 years from now? And what happens if, you have Alzheimer's, an extended stay, right? Cognitive disorders, dementia, right? Nothing that requires a short-term stay, but you could be 8, 10 years, could absolutely bankrupt or wipe out a family estate. I put the continuation of benefit inflation rider at 3%. And I said, let's only inflate that for 20 years, because if somebody is 64 right now, 20 years, said, hey, they're probably going to go out on claim around 84, 85, so maybe 90. We have more centurions living now more than ever. And then you hit calculate. And then when you hit calculate, I had already downloaded this, so I'm going to bring this. I think it's this one. Let me bring that up. Yeah, it's just the one. So when I bring this up, it will create an illustration for you that you'll be able to go through. But let me just help you to understand how this works. Your 150 becomes 180, and they're going to pay that out of a whole life contract, 18 grand a year. These are guaranteed contractually, premiums never to go up. Now, the benefit triggers work just like traditional long-term care. 2 out of 6 ADLs, right? And it gives you all these other additional cares. You can read through this if you print it, but just understand, ADLs are when you can't feed yourself, when you can't transfer, when you can't get dressed. These are examples of things that would trigger. And once you trigger, then it would pay a claim. The elimination period, think of that as a deductible. So that's like 90 days, right, before they'll pay a claim. But if you're 90 days, you've been diagnosed, they're going to pay this out. And then this is what it would look like. Your premium here, 18 grand. The face amount, if you did one payment, there's a death benefit that would pay the beneficiaries that you designate 215,000. But what I want you to see is what they're doing is they're going to spend down this face amount if you go down on claim. And then once this ends, that's that 10-year period, right? Then it's going to go into continuation of benefits. And here's the key word, for life, right? This is for life. So it's lifetime benefits. So as we go through all the details here, I'm not going to torture us. I'm just going to take us to year 20. And what this does is it says for a single person, for the first 10 years, right, they will pay out the AOB monthly benefit, and then it goes to the COB. So it's going to pay, in this example, $4,304 a month. And then when it goes out on COB, this is the inflation. So it's a way to cover your internal home health care. And then notice that if something happens anywhere in here, that there's a death benefit. If somebody wakes up in 10 years from now and says, I want my money back, you won't get all of the 150. You get 135 or 138. This is contractually guaranteed. So it's just a great way to get your cake and eat it too. So this is an example for a single person, right? And so the initial period is 4,300, and then the end of the 10 years per individual. So it's just a great way to have this as a single. Now I'm going to do this same thing, and we can do this live. I'm going to do for a married couple. So married couple, I go joint life. Now I have Mrs. Lesser in here as the person. She is not 60. She would absolutely punch me right now if I did. Neither of us smoked. It's still the single premium annuity, still the same 50 months. I mean, we can play around with this. It would come from qualified money, same 150, right? And you might look at that and go, you know what, maybe 4,000 or 5,000 or 6,000 isn't enough. Well, this is where you can play with this number. But I just wanted to use something where we're not trying to consume the entire IRA. It's just an idea to be able to put it in. Everything else remained the same. And now because that's the same, now I just go over here to the illustration. Let me blow this up. And we look at the same thing. It's the same thing, but it's just insuring 2 lives. So now what happens is, so the 18 grand, the death benefit is now 185. It came down a little bit. But notice here, this is lifetime benefit. Again, this is part of the reason. And now the benefit on both lives is $7,400 a month. And once this runs out, it goes over to the continuation of benefits. So it's just a way to turn around and put something in place. And if I go out there to age 20, right, we have that increasing, this amount here is increasing with inflation. So the 74 is here, but as we get older, this increases. So it's just a way to protect the family, protect the estate, to guard against long-term care. Now, if somebody needs a 100% guarantee that not to lose the money, this is not a complete return of premium product, right? So if you turn around, so think about this. You turn around and put in 150, you got a bonus of 180. First payment went in and turned around and you go, I want to cancel. Okay, would not be suggested, but let's say an emergency comes up. If that happens, you're only going to get back, in this example, 113. So it's not a wise choice. So, that's why I said, just think about it, see what your circumstances are. But as you get older and part of this surrender value starts to go up, you are guaranteed that if you never use it, a death is certain in this life. And we will turn around and make sure that that a portion or all of it, depending on the year, will replace the estate. So that is ultimately the presentation. Again, I want to invite you all to explore that yourself. Here's our disclosures. I have to put that out there. That's my CYA. Say I didn't come up with the terms long-term care. These are examples. It's hypothetical. It's not based on a real case. But I do this each and every day for clients. Everybody's circumstances are different. I understand that, if in your core you go long-term care is expensive, I agree. It has become expensive. So think about it. If Genworth took a $6 billion loss, and for all intents and purposes, you have to look at that and go, if some of the smartest people in the room have mispriced the product, putting something in place which is actually ironclad and guaranteed cannot go up is not a bad idea. And then when you turn around and you go, okay, you know what, how much do we insure for? That's an unknown. We don't necessarily have to, I don't want you to turn around and be broke, use the entire IRA to do it. But if you're saying, you know what, we figured out our cash flow, we've gotten it to retirement, and we know that we're probably not going to spend anything and we're going to leave it for the kids. Well, what happens if in that decision-making process, somebody does go out on claim? And now all of a sudden, everything that was left for the kids is now going to the nursing home or for the home health care, and it wipes out the estate. That absolutely happens every day. And, there are strategies with attorneys and doing Medicare spend down and, all kinds of things. But something like this with a little bit of foresight is, I think, prudent. So that's my disclosure. If you've been invited on here by another professional that I work with and you have questions, we all are using the same carrier. This is One America. It's an A-rated company. They've been doing this forever. They're leaders and have been really one of the steady eddies, right? They've just created a strategy that is allowing you to have true long-term care. And again, I want to thank each and every one of you. Stay safe. Thank you for taking time to be out here today. Have a great day. And if you need me, you know where to find me. Bye-bye.